Our guest says the Bank of Canada is likely to stand pat when it comes to interest rates on Wednesday. We're joined by Karl Schamotta, Chief Market Strategist at Corpay. Karl, thanks very much for joining us. And those strong job numbers on Friday, do you see those as cementing the case that the Bank of Canada holds off for any interest rate changes?
Oh, yeah. I think, the bank itself has definitely moved to the sidelines. Officials have said that the rates are at a good place. It is not, there's no momentum here for adjusting policy at this point. What's sort of crazy about it, though, is that the strength of those job numbers led markets to price in a rate hike at the October meeting or by the October meeting in 2026. And so, I would sort of caution market participants here that although the bank is very likely to deliver on expectations by holding policy firm and not making any adjustments today, Macklem might actually want to talk markets down a bit. He might want to sound slightly more dovish, just simply on the basis that officials don't want to see an unwarranted tightening in financial conditions on the basis that markets are now expecting rates to start climbing by the end of next year.
So you mean that in anticipation of a possible interest rate increase late next year, the markets might start adjusting to that? What would people start doing, Karl?
Yeah, so generally what happens is that, if we expect rates to begin going up in the future, interest rates in the market begin moving up in sympathy with that. And so, what that does is it creates a feedback loop, right? It sort of unwinds the loosening in financial conditions that the bank had been trying to achieve, right? It starts to translate into a tightening in financial conditions. It becomes more difficult to borrow. It becomes more expensive to borrow. And that all, sort of works against what the bank might be trying to achieve. It may be, reasonably content with that for now, but they don't want to see this go too far to the extent that, it does start to eat into the progress that they've made in housing markets and in bolstering overall economic growth.
A pretty amazing story that the Chinese surplus, now above $1 trillion US, despite a slide in sales to the US. You call this widening trade surplus the biggest fault line in the global economy?
That's right. I think this is by far the biggest issue facing the world economy right now, just given the fact that, what's happening here is although direct exports to the United States are falling, in other words, the direct channel of, manufactured products going from China to the U.S. is going down, what is happening is that goods are being transshipped to other countries. So to some extent, other countries are acting as intermediaries in supply chains. So for example, Chinese goods moved to Vietnam, are given sort of a light reprocessing and sent on to the US, or what's happening is that Chinese exports are crowding out imports in other countries. In other words, China's taking that surplus of cheap products that it's producing, which, by the way, have been going down in price in recent years, and pushing those into Europe, into Canada, into the emerging markets. And what that leads to is a situation in which, manufacturing employment comes under pressure in these countries. Overall GDP comes under pressure. And you start to see the same sort of political schisms widening in these economies that we saw in the U.S. over the last 2 decades. And so, my worry here is that if China doesn't change course, if the U.S. doesn't change course, we could be looking at a round of disruption everywhere else as people, as leaders in these countries try to raise trade barriers and try to, fight their own corner as much as they can.
So the risk of a trade war, in other words.
Yeah, trade war, although I would say, at this point, trade war probably doesn't do it all justice. We're well beyond just this idea that we're going to raise protectionist barriers against one another. What we are seeing is, the march of government intervention around the world. Governments are becoming, much more activist in terms of how they manipulate, variables in their own economies, how they, work with and against the rest of the world world to achieve geoeconomic goals, all of that. And so, fundamentally what this leads to and what it is leading to is a reversal in that post-war economic order, that globalization that really generated so much of the wealth that we have today. So, I don't see this as being a positive development. I would hope that at some point China tries to rebalance toward domestic demand, tries to support, domestic consumer spending, and the U.S. rethinks how it approaches its tariff regime. Right now, it's throwing individual bilateral tariffs on a wide range of countries and different categories and such, and that just, every economist out there knows that is not successful in reducing your trade deficit. The U.S. needs to adopt a different growth model in order to reduce its trade deficit and to reduce this global imbalance that's emerged.
Karl, thank you very much as ever. Really appreciate it.
Thanks for having me.
Karl Schamotta, Chief Market Strategist at Corpay.